Paige White, and this is Tasha Piaski, and today we are going to be discussing the case brief of Commissioner versus Glenshaw Glass Co. and William Goldman Theaters, Inc., and this took place in 1955.
This litigation actually involves two cases. From what we can tell is they were combined because they have identical issues for both, which is whether or not punitive damages are taxable to the taxpayer. But in both those cases there are independent factual background information. None of the facts were in dispute with the court going into the Supreme Court, and the cases were combined for heard in bank, which means that all of the judges were present to hear the litigation.
So a little bit of background. So for Glenshaw Glass Co., they were a manufacturer of glass bottles and containers, and they started to take litigation with Hartford Empire Co., which is a machinery manufacturer that they used. They accused Hartford of violating antitrust laws, and Glenshaw received a settlement of about $800,000, of which part of it was punitive damages. So Glenshaw reported part of it, but did not report the amount of punitive damages as income.
Some of the background facts are about the same with the Goldman side. William Goldman Theaters is operated as a motion picture houses, and they had litigations against Lowe's Inc., which was a motion picture distributor. And after accusing them with the same type of violating antitrust laws, they received a settlement, which part of it was punitive damages. They actually received $125,000 for loss of profits, and that was turned into a trimble, which means tripling the amount of the settlement. So the $250,000 left of the $375 were considered punitive damages, and Goldman did not report the amount of the $250,000 as punitive as income.
So some of the prior proceedings before this Supreme Court case was originally just Glenshaw versus the Commissioner, and that was in the U.S. Tax Court in 1949. And there was also an individual tax court for William Goldman Theaters, and that was in 1953. And the decision of William Goldman Theaters was actually based largely upon the decision that was made in Glenshaw Glass Co., which was basically that punitive damages are not considered income. Part of that is because of a prior court case that said income was basically gains from capital or labor, which punitive damages would not be considered either of those. And then the IRS did not agree with those holdings, so it got sent to the Court of Appeals, where they joined the two cases because they had similar issues. But again, the appeals court sided with the taxpayer, again based upon previous court rulings and the definition of income at the time. So then eventually the IRS said, okay, this needs to go to Supreme Court, because they were basically saying just because it was held in these previous court cases, they think it's changed now. It's no longer applicable.
The decision made at the Supreme Court level was that yes, punitive damages are taxable, and that was Chief Justice Warren issued the opinion that the amount of punitive damages that both of the companies had failed to report previously would be considered taxable gross income based on the Section 22A of the Internal Revenue Code of 1939, which reversed the opinions that were set forth saying it was non-taxable at the tax court and the Court of Appeals.
So what was the immediate impact of this decision? So at the time, this question of the definition of income was a common question that came up in court cases a lot, and a lot of the lower courts had different interpretations of it. And so basically this case redefined income. So instead of it being gains on capital or labor, it was basically being all-inclusive, any sort of income that was earned that wasn't specifically exempt. And so they came up with this three-part test of income, which was if it was undeniable accessions to wealth clearly realized over which taxpayers have complete dominion, then it would be considered income.
The importance today is that the Supreme Court now has set forth the defined concept of what income is. So this case was cited over and over again from that point as to that punitive damages are are considered taxable. Before, like Paige had said, they had struggled with the definition prior to this case, but the broad scope of income was applied to the 1954 code. And the term income is a catch-all, which means that all income is considered gross income unless it's specifically exempted by the statute, and punitive damages is not included in that. The conclusion is that punitive damages are taxable because they represent an increase to the wealth of the taxpayer that is not specifically excluded from income by statute, regulations, or administrative ruling.
And I should also add that since this was based on the Internal Revenue Code of 1939, it also started to apply to the new section 61A, which was the same as 22A, which is the new code, and it's basically saying the same thing. It's very broad definition of income.
And if you have any questions, of course, me and Paige are not present in class today, so if you have any questions, please ask the professor, or if y'all would like to send us any emails. Thank you.